Here we are again with JP Gervais, FCC's Chief Agricultural Economist, and we've been talking about FCC's latest report, the 2015 edition of A Look at Global Trade. Now, so far, we've been talking about exchange rates and their impact on Canadian exports. But what other factors should businesses monitor when it comes to trade?
Well, GDP, or gross domestic product, is one of those variables. It makes sense to use GDP of other countries when you're looking at Canadian exports of agri-food products, because GDP of other countries measures the power or the purchasing power of our trade partners. So when their GDP numbers go up, usually they'll have more income to spend on Canadian exports of commodities and food products. Consider the US market first. It is Canada's largest export market for many agricultural and food products. And when the US economy does poorly, as measured by the GDP numbers, our exports to the US are lower. And you think that this may not be the case because the US market is kind of a mature economy, but it really has an impact. For instance, when if you look at 2010, or during just right after the start of the recession in the United States, Canadian agricultural exports to the US fell 24%. Even by 2012, the value of Canadian exports was still 11% below 2008 levels. In fact, we find that GDP is oftentimes more important in helping to boost Canada's exports over time than the exchange rates. As the economy of our trade partners improves, Canada's exports grow. And this is especially true for Canadian food manufacturing exports to developed markets. This is a little bit different though for commodities that are trading to emerging markets. As their stage of development, the demand for Canadian ag products has been very strong lately and is not so sensitive to changes in income. Canadian exports have increased with the expansion in the middle class of these emerging markets and the resulting shift in diets following the increase in income that we've witnessed over the last few years.
Am I right to say that we should look at income to understand where growth will come from in the future?
Well, you are absolutely right. Emerging markets are where income is expected to have the greatest impact on our exports in the years to come. China is a very good example. Projections are that China's GDP will grow at a rate slightly below 7% per year in 2015 and 2016. There's some turbulence in the Chinese economy right now, but it's nevertheless very impressive growth when you compare that growth to developed markets like Japan, which is our second most important destination when it comes to food exports. Canadian agriculture and agri-food exports will grow faster to China than they'll grow in the case of Japan. The outlook for agriculture is positive because expected income growth would lead to an expansion of the demand for high quality commodities and food. And Canada is well positioned to capture that growth.
All that being said, what are the key things that producers should remember and focus on?
Well, we know first that diversification of export markets is growing. And as countries around the world get wealthier, their demand for Canada's agri-food exports will grow. And that's a good thing from a risk management standpoint because expanding the number of export markets provides stability if one of the markets is suddenly shutting down. But I would say that the most important takeaway is this: the Canadian competitive position in global ag and food markets is going to be function more of innovation and productivity and efficiency, just like it's been in the past, than the value of the Canadian dollar over the long run.